Dear students, we will start a new module, Provident Fund. This is important from the examination point of view as a theory question, but two concepts I will tell you that will help you to solve while solving the problems, because it's a usual adjustment in computing salary problems. So let us go into the details. Types of Provident Funds. If you take Provident Fund, four types of Provident Fund: Statutory Provident Fund, Recognized Provident Fund, Public Provident Fund, Unrecognized Provident Fund. This is the classification. Four types of Provident Fund. Usually you will get an exact question to explain the features of Provident Funds. Now first we will start with the Statutory Provident Fund. The word statutory means it's compulsory. It is established under the provisions of the Provident Funds Act 1925. It's under government. Meant for government, semi-government, educational institutions, RBI, universities, state and central universities, all that banks, all that are coming under Statutory Provident Fund. Employer and employee contribution will be there. Usually it's a fund contributed by employer and employee. The usual contribution from the employer is 12% of basic pay plus DA. Then retirement benefits come, compulsory savings. Salaried people, once they retire, they don't have any income. So this will help them to continue with their expenses. Now interest is credited annually. Interest is exempt. Interest earned is exempt from tax, and withdrawal at the time of resignation or retirement. See, for example, you are eligible for Statutory Provident Fund. If you want to change the job after 5 years, then you can change. You can transfer this Provident Fund to the new organization. See, on death, it will be, this amount will be paid to legal heirs. Now, two Provident Funds are coming under EEE category, that is Public Provident Fund and this Statutory Provident Fund. That meaning amount contributed by employer is exempted, then interest earned is exempted, and withdrawal also is exempted. Now Recognized Provident Fund, the term recognized meaning it's recognized by somebody. Now who has recognized? Commissioner of Income Tax. So when they private organization, they will start a unit with more than 20 employees, they will start a Provident Fund. It will be known as Unrecognized Provident Fund, because they have to get the recognition from Commissioner of Income Tax. Then it will become Recognized Provident Fund. So this Recognized Provident Fund meaning it is approved by the Commissioner of Income Tax. This is mainly for the private sector, autonomous bodies and public sector undertakings. That I told you, when 20 or more employees are working, it's compulsory to maintain this Provident Fund under the Employees Provident Fund Act 1925. Now, employers' contribution up to, this is the adjustment I told you, employers' contribution more than 12% will be taxable. Interest credited in excess of 9.5% will be taxable. These are the two adjustments you have to remember from Provident Fund for computing salary income. Always adjustments will be there. Employers' contribution, say for example, if employer is contributing 15%, that 3% of salary will be taxable. That meaning 15 minus 12 is exempted. If interest is credited at the rate of 12%, 12 minus 9.5, 2.5% of interest credited will be taxable. It's very important. Withdrawal at the time of resignation after 5 years of continuous service or death and retirement is exempted. Now Unrecognized Provident Fund, I told you, they will start that Provident Fund in the private sector and they will wait for the recognition from the Commissioner of Income Tax. It's mainly for the private sector. Here also both employer and employee will contribute to the fund. Now we will not get any income tax benefits because the name itself Unrecognized Provident Fund. Now taxability on withdrawal, employer's contribution and interest on employer's contribution will be taxable as salary. So when we will withdraw, if you are withdrawing that, employer's contribution and interest on employer's contribution will be taxed as salary income of the employee. Interest on employee's contribution as taxable as income from other sources. Two heads of income it will represent. First you have to remember, first what I mentioned is about employer's contribution. Second is employee's contribution. So employee's contribution not taxable as it's already taxed from income. You have to remember, second one is interest on employee's contribution. So employee's contribution to the Unrecognized Provident Fund, already it is taxed as his salary income. Now transferred balance is an important concept. I told you, one is in the private sector when they start, a unit with 20 or more employees, they will start a provident fund. It's called unrecognized provident fund. So when it will get the recognition, whatever balance accumulated here will be transferred to recognized provident fund. This is called the transferred balance. Transferred balance. This is very important for 2 marks question. Transferred balance. What is the meaning of transferred balance? So it's very important. Either this is one thing. Otherwise, from statutory provident fund or recognized provident fund, when you are changing the job after 5 years, when you are going to a new organization, then also this transfer can happen from one provident fund to another, or from one provident fund to one organization to another organization. So the term transferred balance refers to accumulated balance in a provident fund account that is transferred from one fund to another. Usually 2 situations. An employee shifts employment from one organization to another. He was working in one company. After 5 years, he is changing to a new company. So the provident fund balance what is saved will shift to the new organization or transfer to new organization. Second is when unrecognized provident fund is getting converted to recognized provident fund. Now, transferred balance in provident fund, when unrecognized provident fund is converted into RPF, fund becomes recognized, existing accumulated balance is called the transferred balance. Now the tax treatment is employer's contribution exceeding 12% of salary and interest exceeding 9.5% per annum accumulated in the previous years becomes taxable in the year of conversion. So here also these rates are important. 12% of employer's contribution, excess of 12% of employer's contribution, and interest credited above 9.5%. Now what is public provident fund? These 3 provident funds are for people working in an organization. Statutory provident fund, recognized provident fund, unrecognized provident fund. Now what about self-employed people? Those people who are doing business, those who are doing professionals. So for them, government has allowed public provident fund to encourage the saving mentality. So government backed saving scheme launched under the Public Provident Fund Act 1968. Only individuals and those who are only residents can open this account. That's very important. Residential status, other not ordinarily resident, non-resident, deemed residents, they cannot open this. Now minors can also have a public provident fund account through a guardian. With the parents they can join. Now Hindu undivided family and NRIs are not eligible to open new provident fund accounts. Now it can be opened at post offices, nationalized banks and authorized private sector banks. When you check the RBI website, you can see that which all banks you can open the public provident fund, or you can go to post office and open that. Minimum tenure is 5 years, but if you want to extend that in blocks of 5 years, it's possible. That meaning you can extend to 20 years, 25 years like that. Minimum deposit in a year is rupees 500 or in multiples of 500. Maximum deposit is 1.5 lakhs per year that you can claim for ATC deduction. Now can be deposited in lump sum or in installments. Maximum 12 installments or deposits only allowed in public provident fund. Now interest set by the government every quarter. Sometimes they will revise the interest payments. Currently the rate is 7.1% per annum compounded annually. So it's a good investment. Interest is credited on 31st March every year. Now the lock-in period is 15 years, but in some cases, in the case of any hospitalization, education expenses of children, marriage and all, partial withdrawal is allowed. Otherwise, you have to wait for 15 years. That means, that is the meaning, that you have got a lock-in period of 15 years. Partial withdrawals are allowed from the 7th year onwards. After 7th year only, partial withdrawals even for emergencies is allowed. Loan facilities available from 3rd to 6th year. So if you want to take a loan from your investment, it is possible. Now, public provident fund also falls in the EEE category. Whatever investment is exempted, interest accumulated is exempted, and maturity amount what you are getting is exempted. So EEE concept is available for public provident fund and statutory provident fund. Now a person can have only one public provident fund account in their name, and you have to nominate somebody. Now you know that bank rules are different. Whatever you do with that, you have to have a nominee for that. Safe investment as it's government guaranteed. You are starting with authorized private sector banks, post offices and nationalized banks. So government control is there. The amount in public provident fund cannot be attached by any court of law for debt recovery. This is the important feature, and this is the only feature available for any savings scheme available in the country. That meaning you have to repay some loan. Court is trying to attach your property, all the bank balance, everything, but they cannot touch the public provident fund. It cannot be. Public provident fund investments are free from court attachments. So it's the safest investment. This is an important feature, and this is the only investment with this feature. Now I'll give you the only that statutory provident fund, recognized provident fund, and unrecognized provident fund. You have to remember SPF, RPF, URPF. So first point, if you see, employees on contribution. Employees on contribution, SPF, it fully qualifies for exemption, ATC deduction. RPF, here ATC deduction you will get, ATC. URPF you don't have to remember, does not qualify for any deduction. This is employees contribution, employees contribution. I told you up to 1.5 lakhs we can claim it ATC. Now employer's contribution, second is employer. This is fully exempted. SPF is fully exempted. Here you have to remember excess of 12% is taxable. Here you will not get. Unrecognized meaning no tax benefits. Interest credited, here it is exempted. Here it is excess of 9.5% is taxable. Here you will not get any benefit. Now transferred balance, this is exempted. Here it is exempted in all cases except if he is leaving the job before 5 years. Before 5 years he will not get any exemption. Now here transferred balance, transferred amount is taxed as salary income. So if you get a question to explain about provident fund, if you give this table, it will explain the features in a nutshell. So it's very important you have to learn this. Whatever I have presented here is what I explained. So this, when you get a question like this in the examination, you can present this with the help of a table, and you can give a heading, comparative analysis of provident fund schemes. So that will satisfy the examiner in giving you marks. So this is what I wanted to explain in this module. Happy learning. Thank you.